Doctors, if you want to build significant cash flow and financial freedom outside of medicine while paying less in taxes, then you don't want to miss the in-person Physician Freedom Summit this October, where 5-minute conversations could lead you to your next mentor, partner, or increase your net worth by millions. I'm Parambala Dandapani. I'm a radiologist, a mom, a real estate investor, and founder of GW Capital and Generational Wealth MD, a growing community of over 20,000 physicians whom I have helped acquire over $300 million worth of real estate. But just like you, for over a decade, I was trudging along the traditional W-2 path, overworked, struggling to balance work and life. Looking back, many of these speakers shaped my journey, and at the Physician Freedom Summit, you will be in the room having face-to-face conversations with these short-term rental gurus who've replaced their clinical earnings through their real estate while slashing their tax bill by hundreds of thousands of dollars, creative financing and alternative investment experts who became financially free in their 30s and 40s and together manage over $1 billion in assets. And you will get insider access to the wealth building strategies that they're pivoting to in this market cycle, while others sit on the sidelines missing out on this once in a lifetime opportunity to build generational wealth. I'm super excited about seeing all of you in person in beautiful California. I know this is going to change your life. I will see you there. Don't forget to sign up at generationalwealthmd.com/summit. What we're discussing today is something everyone has been thinking about. But all of you know, President Trump's tariff policy, it completely created turmoil in the stock market. We lost over 10 trillion, was wiped off major markets across the globe this month when his policy came out. And since then, the market's been going crazy. There's been a lot of back and forth, but there's a real concern about global financial market instability and spiraling of the US economy in general. But while so many are fearful, and it's very natural, right? This is the time where everyone wants to be in a safe haven, right? You want to hold on to cash, right? But in precious metals, hopefully, right? And so as everyone's thinking about these safe havens, the problem is that with some of these safe havens is that while holding your money in these safe havens, you're actually eroding your capital and your purchasing power is going down, especially if inflation spikes with Trump's tariff policy, or interest rates drop, right? With either of those situations, you could be losing purchasing power, and that's going to take you further and further away from your retirement goals. And there is a better way to prepare ourselves. There is a way to not react, but to have an actual investment strategy where you can actually profit in these uncertain times. And that's what I want to deep dive into today.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Parambala Dandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
I want to start off, and I think it's really important always to zoom out and start off with the why, right? What are the mandates for this administration? What are they trying to achieve with the policy? And then we'll look at the short-term and long-term implications on markets with the tariff policy and what is expected to happen. And then finally, I want to wrap it up with how can we, as smart investors, profit from this volatility? How can we shift our investment strategy? And I'm going to break it down. We're going to talk about all the asset classes, but really highlight those that make absolute sense in an environment where there's economic uncertainty, right? Monetary uncertainty. And that's what we're going to deep dive into. So I'm super excited, really excited to hear what all of you have to say about it. So let's get started. Okay. First thing is always going to be really zoom out and look at the why. And some of you probably already understand the dynamics, but for those of you who are just trying to learn more and understand what's happening, there are a few mandates that the administration is trying to achieve with the policy change, right? The first one is the budget deficit. At this time, we are close to a 1.3 trillion deficit in our budget, and over 15% of that is from debt servicing, right? So the United States per se has a debt problem, and the goal is to reduce our debt servicing to about 3% of GDP. And the goal is to also reduce the budget deficit, right? And that And so part of that mandate is also to keep interest rates lower, because we have 8 trillion in treasuries maturing this year, right? So a big part of the problem, which is the reason behind the why behind all the policy changes, is going to be the budget deficit, and finding a solution to it. The second part of that is a bigger problem that has been decades in the making, right? And that is the deindustrialization of the United States. And so since the 1940s, when U.S. established itself as a superpower and built these trade policies and economic order that was set up in the 1940s and then shifted again in the 1970s. But throughout this time frame, what has happened is that domestic manufacturing has gone down and there has been deindustrialization of the US. And how can you be a superpower when a lot of manufacturing happens outside the country, right? And so a big goal, a big mandate for this administration is also to bring back the United States as a domestic manufacturing powerhouse while maintaining, and so the challenge is while maintaining the U.S. reserve currency status, right? And so those are interlinked, but that's a big part of the why, the problem, and this policy change is seen as a solution to it, right? And so those are the two big things. And what the tariffs will help do is that they will help with the budget deficit, because they're increasing revenue, but they're also, the goal behind the tariffs is also to increase domestic manufacturing, and ultimately, and if you notice the conversation happening, you'll see that with the pause in tariffs and everything that's happening in the world today, the tariffs are also being used as a negotiation tool at this point. So it's leverage, right? And the ultimate goal is that if countries leaders agree to a new global tariff order, then there could be potential lowering of the tariffs, right? And so this is a negotiation tool. It's getting people to come to the table, and this is being used as leverage to create a new global trade order potentially that benefits the United States, where U.S. exports become competitive again, all while maintaining U.S. as a reserve currency, right? And so I think it's really important to understand where we're going with all of this, to really then look at, okay, what are the short-term and long-term implications, and how can we invest to position ourselves strongly in this environment, right? And so I think it's really important for us to understand, okay, the big why, what the actual problem is that this is looking to solve, so we can go and deep dive and take a look at the impact. Okay, before we talk about the investment strategy, I think the next thing that I want us to talk about is going to be the short-term and long-term impact of the tariff policy. Now, there are a lot of variables in the equation. Now, we know what the mandate is. We know what we're looking to achieve. We know what the problem is. We know what the potential solution would be. But there are a lot of variables here, right? Because again, we're getting people to come to the table. There will be negotiations. There will be reactions from governments. And so when we're thinking about short-term and long-term impact, we know some things for certain. And there are other things where there are multiple variables. We don't know where it will land, but let's try to unpack that and see where we land. Okay, so the first thing is going to be short-term impact, right? What is the short-term impact of everything that's happening? What do we know for a fact, and what are the unknown variables in there that affect certain pieces of the puzzle? So the first thing is going to be stock market and bond market volatility, and both those markets are going to see volatility in the coming months as things fall into place, right? And we're not seeing the same volatility with the real estate market, and that's typical. That's across different market cycles. Cap rates not really seeing major shifts at this point. Asset values aren't seeing major shifts because real estate is more based on the fundamentals, and it will take time for shifts to happen over there. In the short term, we're not really seeing any changes to values, asset values, cap rates, but there will be volatility in the stock market and the bond market. Inflation. Now, the tariffs per se, are going to be pro-inflationary. And so we do expect inflation to rise over time, right? So that's a short and a long-term consequence of tariffs. But what's happening to economic growth as costs increase, right? With tariffs, the cost to companies will increase. That decreases revenue and capital available for investments. And so that will result in economic slowing, right? A slowing of the economy per se. So that's expected. And now, what's going to happen to interest rates? Again, this is an interesting question, right? And so because there are opposing forces as far as interest rates go. Now, interest rates with rising inflation, and as bonds and dollars are being sold, interest rates are expected to rise. But if we do see economic slowing, which is also anticipated, then interest rates can lower. So that is one of those things where we'll have to just wait and see where things go. I guess as part of the mandate is lowering of interest rates, given our budget deficit. We're likely going to see that, but we really don't know where that's going to land. So there's a little more uncertainty with interest rates compared to what we thought it was going to be last month, right? And so again, the mandate is for lower interest rates because it does affect our ability as a country to, to service our debt. And so most likely interest rates will drop, but there is uncertainty there because there are opposing forces over there. What can we expect with real estate prices? Again, like I said, we're not seeing the same volatility. What can we expect with real estate rents? Now, pro-inflationary markets do see a rise in rent. And, when there's decreased housing supply, which is that's the market we're in, there are low transaction volumes. Typically, you can expect rents to go up in those situations, but in a period of economic slowdown, rents will likely lower, right? So again, opposing forces there. In the short term, we don't know where that's going to land. We'll have to wait and watch. Now, that's a short-term impact. What can we expect in the long term, right? And so let's look at the long term, expectations. As far as inflation, because tariffs are pro-inflationary, in all likelihood, we will see rising rents and rising home prices, right? And a rise in inflation. What's going to happen to housing affordability? We will likely see further worsening of housing affordability as we see costs go up with tariffs, construction slowing down. Now, again, it's important to remember that, in spite of higher tariffs on certain countries, and again, where that's going to fall, we can potentially expect about a 5-10% rise in construction costs, right? But that and the economic uncertainty per se is slowing down construction starts. Construction starts have been slowing down since interest rates went up in 2022. And so again, further slowing of construction, of new builds, what that's going to do is with that and elevated interest rates and elevated home prices with inflation, we're just going to see more erosion of housing affordability and a higher demand for rentals. So that's what we're expecting in the long term. And so the other piece to the puzzle over here is going to be, what can we expect? And so inflation, we talked about housing affordability. What can we expect in terms of global trade and financial order? Again, a lot of that is going to be there are a lot of variables over there. We know what the mandates are. We know what the outcome that the United States expects is. But again, a lot of that is going to be based on negotiation. So we'll have to wait and see how things play out, right? Now, we've established that we're likely in a pro-inflation, a higher inflationary environment, but we've also established that we're likely in an environment where there is a lot of uncertainty, economic and monetary. And then the big question is, as investors, right? So so we've understood what the underlying dynamics are. We've understood what the short-term and long-term impacts are. I guess the bottom line question always is going to be, as an investor, right? What is the strategy for us in this uncertain economy with uncertain monetary and trade policies, right? So what are the guiding principles? And so I would say I wanted to simplify it, right? In a sense, how do you simplify your thinking? Because I've been talking to so many of you over the last week, and many of you have these criteria, right? If the stock market drops by 20%, I'm going to infuse this much capital in. But these times, it's very hard for us to stay away from what we're hearing in the media and not get stuck in analysis paralysis. So I wanted to really streamline this to, okay, let's talk about 3 things to keep in mind as we navigate these situations, right? As we navigate this market, and what can be our guiding principle as we're looking to invest. And so the first one is going to be, and I'm going to really deep dive and break it down as we go along.
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
But the first one's going to be, in times of economic and monetary uncertainty, what you want to be investing is in real and essential assets with cash flow, right? So real assets that are essential, people will prioritize spending on these, and that have actual cash flow. Because whatever happens to the monetary system, even if we go back to the barter system, right? People will barter to get these, so to be able to have access to this, right? So you're looking for real assets that are essential and that have cash flow. Okay, so that, and I'm going to break that down further once I highlight all three principles. But that's the first one, right? So the ultimate investments, in times of monetary uncertainty, are always going to be real assets that are essential with cash flow. Now, the second point is going to be, it's about risk mitigation, right? Now, the important thing to remember, and we've always highlighted this on our platform, you always want to think about risk mitigation. Diversification into alternative assets, diversifying out of the stock market is important, not only from a returns perspective. It's amazing that we're tax efficient in alternative assets, that's where all the tax breaks are. It's amazing that we get returns that are 2 to 6 times what we would get in the stock market. But the most important thing is risk mitigation. And in times like this, it's always the mandate, right, is to asset allocate into uncorrelated assets like, alternative investments. That's real estate. It could be precious metals, things that aren't correlated to the stock market, because that lowers risk in your portfolio. And the biggest takeaway is going to be, you really need to know what your asset allocation is, right? And then the best part is that it doesn't change across these market cycles, right? Know what your asset allocation is. For most people, ultra high net worth people, it's going to be about 20% in fixed income assets. Those are your safe havens, right? Your traditional safe havens. It's going to be about 30% in the stock market, another 50% in alternative assets. Now, for people starting out, for you may say, I want to be 30% in alternative assets. I want to be 20% in stocks and bonds and 50% in the stock market. Whatever that is, right? Diversification is key over here. So this is a time to lean into diversification as risk mitigation. You want to be in uncorrelated assets, right? So that's point number 2. Now, the third thing is the hardest thing to keep in mind and to follow through in this time, which is to play the long game, right? So it's to stick to your criteria. And your criteria is, if your criteria is, I want to have 50% allocation into stocks or 30%, and your entire portfolio dropped by 20%, you're out of that allocation now, right? And so your allocation has shifted. You want to buy the dip. And you want to think about the long term. You're not going to get swayed by media perspective. You are not going to get swayed by clickbait, and you aren't going to get stuck analyzing what is going to happen to the monetary, to global trade. You're not going to get stuck analyzing what's going to happen to the stock market, and you're not going to get stuck analyzing if this is actually the bottom of the stock market, if it can go down further. You stick to your criteria, right? So the third point, the most important one and the hardest one to follow through with, is playing the long game. You want to play the long game, and you want to stick to your criteria. Okay, so those are the 3 broad guidelines for investing in times of economic uncertainty, okay, economic and monetary uncertainty. But I want to deep dive into that first point, which is what are the real and essential assets with cash flow that you will be looking to, as your actual true safe haven in these markets. But before that, for those of you who haven't signed up for our summit that's coming up in October, the Physician Freedom Summit, this is for anyone who's thinking. And so when I say, okay, I want you to be diversified, I want you to have asset allocation into alternative assets, and you're thinking, I'm just looking to start, and how do I really take action? This is it. There are so many barriers to investing. How do I get the momentum? The summit is for you. For those of you who are thinking, well, I'm already in real estate and I really want to scale, but it's really hard to pick the right strategy to scale amid all this uncertainty, this is the summit for you. This is where you make real life connections. In times like these, you really need to lean into the right community of people who are action takers, who are leaning into these fundamental principles of investing. You want to lean into mentorship and, real life conversations, 5-minute conversations with physicians who have achieved financial freedom, who are educating themselves, who are financial experts, who are taking action and scaling even in these times. That's what the summit gives you. So just make sure you've signed up. The prices are going up end of this month by 30%. So lock in, just go in and sign up for the summit. It's generationalwealthmd.com/summit. You don't want to miss this. I've attended in-person events, and the value of an in-person event is tremendous. It really, I've had mentors. I've had like a single conversation that has given me 6 figures in seven figures in revenue. So sign up if you haven't. But that being said, let's talk about all these different asset classes and what are the ones you really need to be leaning into. So like I said, if you're invested in the stock market, which most of us are through retirement accounts or outside of retirement accounts, this is the time where you are buying the dip and sticking to your asset allocation, right? And you're not overanalyzing. If you're investing in bonds, high yield savings accounts, and hopefully you're at least in high yield savings accounts, right? And you're not getting the 0.1% or the 1% in your Bank of America account. So if you're invested in those fixed income assets, this is a time again for you to just stick to your asset allocation. There is safety in those assets. They don't typically have the same volatility, right? But again, you need to stick to your asset allocation because in times of high inflation, right? High inflationary environments, problem with these assets is that once you factor in taxes, because you are paying marginal taxes on your returns from interest and your bond returns. So once you factor in taxes and once you factor in inflation, these assets don't really keep up with inflation or exceed inflation significantly, right? And so as interest rates go down, you're going to notice, and if you're in an inflationary environment, your purchasing power is eroding, right? So after taxes, and if you're like me in California, you're paying 50% of your interest in taxes, you're probably left with 2, maximum 3% in terms of returns. And if inflation is over 3%, then your purchasing power is eroding, right? That's the most important thing. Your return should always exceed inflation. Make sure you're factoring in taxes. Make sure you're factoring in inflation. And so this is not where you want to start hoarding your money. If you do that, your purchasing power is eroding. Stick to your asset allocation. There's a place for them, but just make sure you aren't over allocating over there, which is a natural tendency in times of uncertainty. Now, let's move to the real and essential asset that puts cash flow in your pocket. I want to talk about, and these are assets, interestingly, the assets I'm going to talk about are perfect for a high inflationary environment and are also perfect for an environment where we have economic instability, right? And so I'm going to talk about real estate and I'm also going to talk about precious metals. Let's start with real estate, right? Now, real estate, you have cash flow, right? And so it makes absolute sense. And so you want to be buying right. And again, a lot of you are in our coaching program, and which is where we talk about buying profitable properties. You do not want to buy a property just for the tax savings. You do not want to buy a property without running the numbers and knowing if it's actually profitable. But a property, a real asset that provides essential services like housing and has positive cash flow is something you want to hold in these environments because if we go into a high inflationary environment, cost of construction goes up and the cost of existing assets and rents will go up because they are inflation correlated, right? Again, we talked about housing affordability with high interest rates, with high asset values and construction slowing down. We're, again, worsening the affordability crisis in this country. And so there will be a higher demand for rentals. You are buying at a discount to replacement cost in high inflationary environments, right? Because if the cost of the replacement goes up and you have an asset that you've acquired, you've already purchased it at a discount, right? And so these are non-correlated assets. There's less volatility. This is what you want to be leaning into. The returns from real estate are not just cash flow. It's one of the best hedges against inflation is leveraged real estate because your debt stays fixed. And as inflation increases, you're still paying the same monthly payment for your debt across 30 years, right? While your cash flow increases because your rents are going up. You have an asset where the cash flow is constantly going up. So it's the best hedge against inflation in times of economic uncertainty. Even if prices don't go up, you're still getting the tax savings, the tax efficiencies of real estate. All cash flow from real estate is tax efficient because of depreciation. It's the best hedge against inflation. You have debt pay down happening, which is, again, you're building up equity over time, all of that. But if you just look at cash flow, which is what you need to be focusing on in times of monetary uncertainty, then that's the asset you want to lean into, right? Now, apart from real estate, precious metals are another investment that people lean into in times of monetary uncertainty, also in times of high inflation, right? But now remember that gold is a safe haven. It's not an investment because an asset is something that puts money into your pocket that has cash flow, right? And that's why I was highlighting you want to invest in real assets that are essential, right? That have cash flow. And so precious metals, central banks are buying gold. And the question always comes up, what is your optimal asset allocation for precious metals? And I think there are multiple studies where they show between 10 to 15% of your asset allocation should be to precious metals, right? And this is across all cycles. And holding physical gold over ETFs or mining stocks is always better because there is counterparty risk, currency and banking risk in those ETFs and mining companies. But actually holding physical gold and 10 to 15% of your asset allocation into precious metals is what's recommended. Now, again, that it is not an income producing asset, so it's not an asset per se. It's it's not an investment, but it does give you liquidity, and it is a safe haven. So it's almost like an insurance, right? And it doesn't have counterparty risk, currency or banking risk. You can use it as equity, as collateral to borrow against, and you can use that to buy income producing assets, right? And as long as there's an arbitrage over there. So that's how you view precious metals, but it does have a place in your portfolio, and it's a good time to be intentional about it. But again, if you notice, it comes back to those three key points. Know what your asset allocation should be, and make sure you're thinking about the long game when you're investing. And interestingly, the principles don't really change across market cycles, and that's the best part, right? And so in these times, you're still going back to those fundamental policies of investing, the fundamental strategies, which are for the long term, right? Apart from that, agriculture and energy is also, they're also real and essential, and there are investments worth mentioning. Energy sector is going to see volatility from a demand supply perspective, so we don't know where we're going to land over there. But those are again things to consider in times of economic instability. Okay, that being said, I want to highlight those 3 points because that is the crux of what you need to take action, right? And so the ultimate investment strategy in times of economic and monetary uncertainty also happens to be the same thing you would do in times of high inflation, which is what we expect with the tariff policy, right? And the first core point there, which is the biggest takeaway, is you want to be invested in real and essential assets with cash flow that people will prioritize spending on. And then, it is still the time for you to really stick to your asset allocation, because that is how you diversify and lower risk across your portfolio. If you're thinking about risk mitigation, then don't just think about moving to the safe havens. We're thinking about diversification and investing in those uncorrelated assets, right? So the more uncorrelated assets you have, the more you're mitigating risk across your portfolio. And then think about the long-term game. That is the hardest thing to do, to not get stuck in analysis paralysis, to not get sucked into the clickbait, but to stick to your long-term strategy and to not speculate about what's going to happen or what the bottom of the market is. And I think that's a wrap in terms of how I want you to be thinking about investing for the rest of the year. If you go into a high inflationary environment, or as we expect to see, a shift in terms of where the global trade policies, monetary policies, with all of the uncertainty, I think those should be our guiding principles as we seek to invest this year. Thank you, guys. Now, I'll see everyone soon next week.